In this video we're going to look at sources of finance. First of all, let's start with looking at the reasons for finance in a business. Well, a new business will require resources in order to buy equipment, materials, premises, and all of the services necessary to establish the business. So clearly a new business will need resources. So a new business will need sources of finance to enable it to get started. It will need the equipment, the premises, the materials, and so on. In most cases, production and expenditure take place in advance of receipts from sales. So even with an established business, they need sources of finance because their production takes place before they sell the product. It should be pretty obvious that production takes place, the product is produced, and then the product is sold. So there is a time difference between production and the receipt of the resources, the money from the sale. So the company has to buy raw materials, let's say. It has to pay employees, it has to pay overheads, it has to pay all of the business expenses. And at the same time, it's not receiving anything from sales. The items are still in production. When the items finish in production and are completed, they have to be distributed, and finally they have to be sold. And even when they're sold, there may be a period of time before the organization can receive its money, before it receives the benefits from production. It may be a month. The company who buys the product may not pay for a month, let's say. They have a period of credit of perhaps 1 month as a condition of purchasing the product. So the company that produced it will have to wait even longer. So clearly the company that produces the product will have to have some sources of finance to pay the bills and pay the overheads and pay the employees and so on, buy the raw materials, and continue to work in that period whilst it's waiting for the receipts from the sales. So here are two major reasons why finance is required within a business. Now, the external sources of finance may take two forms: borrowing from an institution, for example, borrowing from a bank. So that's external, and that's one way in which finance may be raised. Or it may invite investors or even business angels, perhaps certain types of investors who like to be involved in business and who will help new businesses in particular to start up and provide finance at a very early stage in the company's formation. So the company might invite these type of people to take a stake in the business, so they become shareholders in the business. And that's a possible source of finance. The investors put capital into the business, but in return get a share of the business. Now, the life cycle of a firm may be viewed under the following headings, and it's very similar to the life cycle of products. We have the startup stage, where sometimes it's just an idea someone has. The entrepreneur has an idea, and then they move into the very early stages of starting the business, but they're really starting with nothing. And in a sense, all businesses start with nothing. It's only when the idea is tested or checked or evaluated and they think it has commercial potential, then sources of finance are sought. The sources of finance might be the person who came up with the idea in the first place. It depends on the scale of the undertaking that's required, the scale of the business that's required. It might be a very small scale business, but depending on that, the type of finance will be worked out, and then the initiator of the business will try to raise the finance to bring the business into existence. And once the business is set up, it'll go through a period of growth. At least that's the expectation, that's the hope, that the business will flourish and it'll grow. And in that period, there'll be perhaps less requirements for sourcing, for resources from outside. There'll be less recourse to the banks looking for loans, or because the business is growing and it's perhaps prospering. There'll be a period when it ceases to grow, it just consolidates. It has, in a sense, exploited the market. It has fulfilled the requirements of the market, and there are very few opportunities for it to grow further, unless it globalizes and goes to other countries and tries to produce for other countries. But after the growth period, we call it consolidation, when it's trying to ensure its existence. It's trying to ensure that it has a sound base to continue into the future. And then there's maturity, where it's well established within the business community. It's perhaps recognized by the consumers. It has an established reputation. So it's entered a period of maturity. It's well established. After that, there's the possibility of decline, where the business starts to become less attractive to customers. The products may be seen as old-fashioned or out of date, and the business starts to decline. So we can see something very similar here to the product life cycle in the growth and maturity and decline of businesses. We have the startup phase, where there's sources of finance are required. The growth phase, again, sources of finance might be required to finance the growth. Then it consolidates. There might be less requirements for resources and for external sources of capital. Maturity, it's in a sense settled. The business is not experiencing rapid growth or decline. It's just now established as a part of the market. But after that, it may enter into a period of decline. Now, the classification of the various sources of finance, well, we have debt finance and equity finance, two different types. We also have external and internal sources of finance. Now, the sources of finance may be classified according to its repayment period. For example, that's one way in which we could work out the type of finance and the classification of finance that companies seek. So, for example, the repayment period may be never. It never has to repay. That's a possibility. There are sources of finance that are not repaid. For example, issuing shares to investors. Well, the investors buy the shares. They don't ever get their investment back from the company. They get a share of the business and the share in the success of the business, if the business is successful. But they never actually get their investment back. They may sell their shares at a later stage. They may sell the shares at a profit, or they may sell them at a loss. But they don't actually get the investment back from the company. We'll talk about shares later. There's long-term finance. Long-term finance could be in the form of, again, lending to the company. Perhaps debentures could be one way, where the company borrows from investors and issues a certificate against the borrowing, a promise in a sense to repay the debt in some future time period. It may be very long off, but they also pay a rate of interest on the amount borrowed. It's very similar to borrowing from the bank, except it's called debentures. The companies may raise the finance from investors directly, but it is repaid, and it's repaid over a very long period of time, possibly. Could be medium term. difficult to know what exactly is meant by medium term. It could be 2 years or 5 years, or it depends on the nature of the business. If it's a large manufacturing business making large components, it may be 5 years or 8 years or something of that nature. If it's a small business, it may be medium term, maybe 2 years. It depends. But it just means there is a period of time which, within the context of the business and the type of products it's making, that period of time is not seen as excessive. And the short term, again, problem of definition, but short term might be a year, or it could be 6 months. It depends on the nature of the business and the type of understanding that the investor and the business have when raising the finance. Now, receipts and payments and the business. Well, we think of the business, and the business has sources of finance that come into it. The sources of finance come from, generally speaking, from investors. Some investors will take a share of the business, others may take a debenture holding in the business and give the sources of finance to the business, give some sums of money in effect to the business, but in return the business promises to repay that over a period of time. That's a debenture system. Or it could be ordinary shares. Ordinary shares are shares that the investors have a right to vote in the business. They have a right to have their say in the business. They may be involved in the business indeed, but they don't actually get their investments back from the business. There could also be grants available through government organisations to start businesses and help entrepreneurs get started, because the government sees this as a valuable source of employment within the community. So there are various sources of finance, and these various sources of finance feed into the business. We also have the businesses selling products, which is a source of finance. They sell the products they make or sell the services they make, and receive payment as a consequence, and that flows into the business as well. So it's more resources going into the business. Then we have the output expenses: wages, salaries, consumables, office consumables, paper, printing, utility bills, and so on. And these are flowing out. So that's a drain on the resources of the business. But they also may have to pay dividends to the shareholders. The shareholders, after all, own the business. The ordinary shareholders own the business, and the reason why they started the business in the first place, so that they could get dividends. They didn't start the business for, generally speaking, for any other purpose. They start a business because they anticipate profits, and they anticipate some payment out of the profits to them. They may also have to pay interest. They may have borrowed some resources from the banks, and that means they have to pay interest on what they've borrowed. Again, a leakage of finance out of the business. There may be discretionary payments for legal fees, or for consultancy, for marketing purposes. They may have HR expertise bought in from time to time. Discretionary payments of various types may mean, again, a drain of resources out of the business. So we can start to see the business as this type of framework where we have resources flowing in, the sources of finance and the receipts from sales, and then the various disbursements, the various payments out of the business, wages, salaries, utility bills, raw materials, then dividends, interest, discretionary payments, and so on. We may note two approaches to the management of a business. The proprietor, well, the proprietor is in a sense the owner of the business. This approach sees the owner attempting to be self-reliant. In this case, the proprietor tends to look after the business, set up the business, and try to grow the business, try to remain in charge of the business. The person is the proprietor of the business. Generally speaking, this type of business will be related to perhaps some sort of service, perhaps a restaurant or some sort of catering or a small hotel or this type of activity. We very seldom see proprietors sole ownership for large businesses. We very seldom see sole proprietors in large, say, manufacturing businesses. But we do see it in smaller businesses. And the proprietor tries to maintain control of the business and tries to make sure that the financing of the business can be achieved from sales and that the business can pay its bills and operate without recourse to the banks or towards the financial markets to try and raise funds that way. So the proprietor tries to remain self-sufficient. We also have the entrepreneur. Entrepreneurial businesses are keen to expand, and this approach to business means that they seek finance from any source. So entrepreneurs are the individuals who are very much alert to profit opportunities. They see profit opportunities perhaps where other people can't see them. Sometimes the undertakings may be considered as quite risky by many looking at the business from outside, but the entrepreneur sees profit potential and is willing to take the risk. So they're keen to try and raise finance from any source. Perhaps their idea is to bring the business into existence, get it set up, repay what they've borrowed, and then sell the business, sell it as a going concern, make a profit that way, and then move on to do it again someplace else. We also need to contrast debt and equity. When shares are used as a means of raising finance, then both a share of future profits and a share of the control of the business is forfeited. So the use of shares, ordinary shares, there are different types of shares. There's ordinary shares and preference shares and so on. So when we talk about ordinary shares, we're talking about shares in the business that have ownership of the business. They confer ownership of the business to the owner of the shares. So companies will have an authorized share capital, which is the amount that they are legally allowed to issue. They'll also have an issued share capital, because they may not issue all of the authorized share capital that they're allowed. They may only issue what they need, because they want to keep control of the business. They want to have as little shares issued as possible, so that will give them more control over the business. So when a company wants to raise finance, they may issue shares. That will raise the finance they want, but they will also have to give up part of the ownership of the business. And the owners of the ordinary shares can meet, they'll become shareholders, and they can vote on issues and make suggestions and be involved in the business and watch the business and monitor it. And so the entrepreneur, or the person who started the business, will have this extra responsibility to ensure that the shareholders, the individuals who put capital into the business, that they are satisfied with the performance of the business and they're receiving a dividend in return for their investment. And also that dividend should be more than what they would have received had they put their money into the bank. If they'd put their capital into the bank, they might have got, let's say, 5% per annum. So the company will be expected to pay more than that. So the dividends should be higher. But also, as I said, there's a loss of ownership. The ownership is now divided between the shareholders. The distinction between debt and equity may be summarised in the following table. Finance from share capital. Well, the owners of the shares own the business. Ordinary shares I'm talking about here. So the owners of ordinary shares own the business. And of course, the more shareholders there are, the more difficult it is to make decisions and facilitate everyone's expectations. So the company tries to keep the number of shareholders perhaps quite small. Particularly small companies, they will try to have fewer shareholders. The shareholders may vote and determine the direction of the business. Ordinary shareholders have a right to vote on the direction of the business. So the strategic plan of the business will have to be put before the shareholders, who will evaluate it and think about it and may make changes or recommendations for change. And they can vote on this. And if enough of them vote for a change, then it has to be implemented. If over 51% of the shareholders, the ordinary shareholders, vote for a change in the strategic direction of the business, then the business must follow their instructions. They are the owners of the business. Dividends are paid out of the net earnings of the business. So once the business has paid for all its costs, raw materials, labour and so on, and for investment and all of that, whatever's left over is net earnings. That's profit, and the dividends are paid out of that. So the dividends are from net profits. So it's important that the business tries to make the net profits, because it has to pay the dividends out of it. It has to pay the owners of the business, who are the owners of the ordinary shares. The board of directors of the business determines the level of dividends paid out. So the board of directors, who will be made up from the ordinary shareholders, they have to look at what the net benefits, the net earnings of the business were. What were the net benefits of running the business? What are the net earnings? What's the profit, in other words? And then what proportion of the profit should be paid to the owners of the business, to the ordinary shareholders. Perhaps the business needs to retain some profits for security issues, to make sure that if something goes wrong, they've got the facility to meet that contingency and continue in business. Or the business may need to make investments in the form of new capital equipment. So the board of directors have to decide what proportion of the net earnings are paid out in dividends. Ordinary shares have no maturity date. They don't have to be repaid. So ordinary shares are not repaid by the business. Once the investor buys ordinary shares in the business, that sum of money goes to the business and stays with the business. The shares can be sold later to other investors, and in that case it doesn't involve the business. So the business gets the first sum. The business sells the shares to a shareholder, and the shareholder may then sell the shares to another shareholder. That doesn't involve the business, of course. The business is only involved at the initial stage, the initial sale of the shares. Now, finance from loan capital. Well, a loan represents a debt and does not confer ownership. So if a business borrows from a bank, let's say, then it's got a debt it must repay. But the bank does not own the business. The shareholders own the business, not the bank. But the debt from the bank must be paid before any profits are paid out to shareholders, or the debt from the bank takes priority. The business has no discretion over the amount of interest payable on a loan. The bank determines the interest payments. And when the loan was negotiated, a variable rate of interest may apply. So the rate of interest charged by the bank may vary over the life of the loan, and there's nothing the business can do about that. Creditors have no direct say in the management of the business. The banks, generally speaking, don't get involved in the business. They make a loan to the business, having evaluated the proposal and the application for the loan. Having carefully evaluated, they may make a loan. The amount they charge, the interest rate, that may be variable over the life of the loan, but they don't get involved in the business itself. So they don't attend meetings at the business, or they're not involved with the business. They simply want to make sure that they're repaid with interest. They may have a claim on the assets of the business if the business fails, and they may have priority in getting their payments back. They will be preferenced lenders. Interest on a loan is a business expense and must be paid before dividends are paid out. So the loan does have preference, does have priority, I should say, over payments to shareholders. So the shareholders only get what's left after debts have been serviced, after the debt interest payments have been made, and some of perhaps the capital borrowed has been repaid as well, in accordance with the terms of the loan. So the shareholders have to wait until the business has paid for all of its statutory payments. It has to wait. They have to wait for the business to ensure that it has sufficient reserves to meet contingencies. It has sufficient reserves to invest, that it can pay the banks for any loans it has raised, and it can pay for the operations of the business, the day-to-day operations of the business. So in a sense, the shareholders come last in this line. The loans from the banks must be repaid. There is a time period, and they must be paid within that time period. If they have particular problems in repaying it, it may be possible to restructure the loans, to go back to the banks and renegotiate the arrangements for repayment. They may be able to negotiate a time further into the future if they're having particular problems. But the loans must be repaid. So there's a big difference between share capital and loan capital. Now, businesses with a high proportion of its finance in the form of loans are said to be highly geared. That's what we mean by high gearing for a company. High gearing means a lot of loans as a proportion of its finance. The advantages of high gearing, well, the shareholders have access to more finance, and therefore they may engage in expansion and more entrepreneurial projects. So the shareholders have access to more finance if the banks are willing to lend to the business. The business has become highly geared. There's a lot of loan outstanding. The business owes a lot of its perhaps its future revenues to the banks. But it does enable the business to perhaps expand or diversify its product range. The ownership of the business remains unchanged as finance is raised from loans. So the ownership of the business remains the same. There are no new shareholders involved. The extra finance flowing into the business comes from the banks. It doesn't come from investors. It doesn't come from more ordinary shares being sold. So the number of shareholders remains constant. The business gets access to more funding, which is able to use, as I said, to perhaps research and develop or innovate the product or diversify its product range or expand into new markets or whatever its strategic thinking is. And the number of shareholders does not change. So those are advantages of borrowing. Interest on loans is an expense for tax purposes, so it does actually cut down the tax burden as well. The interest on loans has to be paid, and it's seen as a tax expense, so it's paid before tax is levied on the business. So it reduces the tax burden. In a sense, the loan has been partially subsidized because the business doesn't have to pay so much tax. Now, the disadvantages of high gearing. Well, loans must be repaid, and this increases the possibility of company failure. So if a company is highly geared, it still must repay the loans. So it must produce a profit. It must produce the resources to repay the loan. If it doesn't, the banks could call in the loans, and once they become due, if the company can't pay, the company may be forced to close down and its assets sold, and whatever's received from its assets, the sale of its assets, will go to the banks to try and repay the amount that was loaned to the business. So the possibility of company failure is increased with high gearing. The terms and conditions of loans may restrict the use of assets. The banks may make the loans to the business, but they may have conditions attached. That the business works in a particular way or locates its business in a certain place, or it may have certain conditions which may restrict the freedom of the business, and which may indeed militate against the achievement of its strategic objectives. The banks may issue conditions. It's up to the company to decide if they want to borrow on those conditions or not. The impact of high gearing is to reduce dividends as a proportion of sales, and this means that any fluctuation in sales revenue may have an amplified effect on dividends. So high gearing reduces dividends as a proportion of sales. When dividends are paid, the dividends have to be paid out of sales, but dividends are paid after all of the other required payments are made, including payments for loans to the banks. So sales, the importance of sales as a means of sales revenue, I should say, as a means of generating the dividends, which is the way the dividends come about. But the importance of sales is amplified because the net benefits from the sales will have to be paid in the form of dividends after the banks have been paid. So the banks get first call on profits. So loans to banks must be paid before the dividends. And that means that for dividends to be maintained, they have to have adequate sales and adequate revenue flowing in to maintain the dividends in the light of the payments that have to be made to the banks to pay for the interest charges on the debts. It sounds complicated. In fact, it's, when you read it over and think about it, it's actually quite straightforward. A highly geared business may find it difficult to raise further loan finance. Well, once the business has got several loans in place, then banks may start to refuse further loans, because the possibility of company failure then becomes quite serious, and the ability of the banks to get back its lending in the event of failure is diminished when more loans are being issued, because simply the assets of the business may not compensate for the loans that have been made. If the business fails and the assets of the business have to be sold, and then the revenues generated from the sales of the assets go back to the banks have to ensure that those revenues will cover what was lent. The banks are not in business to lose. The banks are in business to make a profit. So we have long-term debt, medium-term debt, and short-term debt. Well, long-term debt. There are two types of long-term debt. Debentures, I mentioned those earlier. These are bonds issued by a company and may be traded after issue. So simply the company issues a bond, and it'll pay interest on the bond, and it'll also repay the bond at some future date. So it's very similar to raising a loan from a bank. It pays a dividend, an interest I should say, not a dividend. It doesn't vary with profitability. They guarantee a rate of interest on the debenture, and there is a time period in the future when the debenture will be repaid. They may also have mortgages. These are loans secured against land and buildings. So the company may own the land where the offices and where the, let's say, the factory is located. So they may be able to mortgage this and raise long-term loans against those assets. Of course, if they default on the loan, the bank may step in and take the land and the premises, in which case the business has to close. So there are risks. Medium-term debt. Well, there are three types of medium-term debt. Loans. These carry restrictions and are made available by banks, as we've been discussing. So the loan could be for a medium term. We're not sure what we mean by medium term. Could be, say, 3 years or 5 years. Depends really on the size of the business and the amount of capital in the business, and indeed the types of loans that the banks are willing to make available to the business. So it could be, say, 3 years, 5 years, something of that nature. It could be hire purchase. This enables the business to buy the resources it requires and to pay for them by installments. This is particularly popular with very expensive pieces of capital equipment. So a company buys a very sophisticated, say, machine, very expensive machine, and as a part of the purchase, the seller agrees to take the payment in installments over a number of years perhaps. So the company buys the machine over a long period of time. There's also lease purchase, similar to hire purchase, with the exception that a deposit is not usually required. So it's the company leasing the machine, but perhaps at the end of a certain period they will come to own the machine. It's a part of the agreement. It's a lease purchase. So they purchase the machine over a number of years, but they don't have to make a big deposit at the start. They just simply start paying for the lease. Lease purchase. Well, businesses is committed to a flow of outgoings according to the contract. And that's one of the downsides of this, that there is a long-term drain on profits and on the resources of the business. Depends on the length of the period of the lease, but there is an obligation for the business to honour the terms of the lease. In effect, there's a contract in place. The total cost of the asset may exceed the purchase price. When lease purchase is put in place, generally speaking, the company who's doing the leasing will get a more advantageous price for the equipment. So it's perhaps more expensive for the company to engage in this type of purchase than buying it outright. Of course, the company may not have the resources to buy it outright, and that's why they're forced into the lease purchase arrangement. But generally speaking, the item is more expensive in this way. The terms of the lease may restrict the use of the asset and therefore reduce the flexibility of the business. Sometimes the company that's selling the item may restrict its uses for various reasons. They don't want the machine to wear out, for example, before the final payment is made, because they may have to replace parts in the machine. So they might specify that the machine can only be used in certain ways. So they may have restrictions on the use of the equipment. And this takes away, of course, from the flexibility of the business. So they may not be able to use the machine in certain ways, or for long continuous runs of production, or so there might be some restrictions on the use of the piece of capital that was acquired as a consequence of having this lease purchase arrangement. So it does take away flexibility from the business. The business will never own the asset, perhaps. If it's just leased, they will never own it, and therefore cannot use it as a source of collateral for future loans. So if it's not lease purchase, if it's just leased, they will never own it. If it's lease purchased, then at some future date they will own it, and they can use it for collateral for future loans. They can go to the banks and try to raise a loan, and should they default on the loan, the bank will get to own that piece of capital equipment, and the bank could sell it and try and get its loan back in that way. But sometimes it's not lease purchase, it's just leased. A piece of equipment is leased from another company, and in this case they never own the machine, they never own that piece of capital, so they can't use it as collateral for negotiations with a bank. So it's not lease purchase, it could be just leased. Now, short-term debt. Well, there are several forms of short-term finance as follows. Short-term finance is required to bridge the gap between the purchase of inputs and the receipt of revenue from the sale of the output. So generally speaking, short-term finance is to bridge the gap between the company buying the, let's say, the inputs, the raw materials, the components, the processing, the manufacturing, the wages and salaries, the overheads, the utility bills, all of the associated bills that come out from the company in the period during which the production is taking place. And then the sale of the item, the distribution and sale of the item, and then perhaps a credit period to the buyer. So there could be quite a long period of time between receiving the order and making the delivery, and receiving the payments later for that delivery. And that may require short-term finance, perhaps a loan for 2 months or a month, whatever. So there might be some short-term finance required to plug that gap. Now, there are several forms of short-term finance. Trade credit, for example. In this case, trade suppliers grant a period of credit to the business. So the company buys the raw materials or the components, but it doesn't have to pay for them immediately. It might pay for them a month later. This means the business may not have to pay for raw materials or other sources for a period of time. In effect, the trade creditors grant an interest-free loan to the business. The creditors may further give a discount to the business if the business settles the debt on time. So depends on the contract for the supply of the particular items. Sometimes creditors may say if the company pays on time with no problems, they'll give a 5% discount or a 10% discount, whatever. So there's incentive for the business to try and pay its creditors on time. But trade credit is one short-term source of finance. There's also what's known as factors. If a business requires the revenue from its sales before the agreed time extended to the debtors, then it may use the services of a factor. A factor buys the trade credit at a discount and collects the cash whenever it's due. The factor makes a profit and the business receives payment early that may ease any cash flow problems. So a factor is a person or an organization that will buy the trade credit. So if a company sells to another company, then they may not receive that money for a month or 2 months. Depends on the terms of the sale. But if they need the capital, if they need that cash before that period is up, they must have the cash before that to pay salaries or wages or whatever, then they may sell the trade credit to a factor. And they sell the trade credit at a discount. So let's say they were owed £10,000 and they were going to receive it at the end of the month. So they may say to the factor, well, we will sell it to you at a discount of 5%. Now that's quite significant because just in simple interest terms, that's 60% over a year. 5% a month for 1 month is 60%. That's simple interest. The APR is, of course, a lot different. So the factor will step in and buy the trade credit. In this way, the factor will make a profit and the business will receive a significant proportion of what it was due at the end of the month and will receive it early to enable them to continue in production. So factors exist to plug that gap as well. There's also overdraft facilities. These are short-term loans from the banks. Now, overdraft facilities have the following characteristics. They're very flexible in that they may be drawn upon, they may have an agreed limit, fixed limit in advance with the banks, but an overdraft facility doesn't have to be used. It could be just an insurance that the company have if they need the resources. So they don't actually have to use the overdraft facility, but they may have it in place just in case it's required. Generally, the overdraft facilities are unsecured. So if the company uses the overdraft facility and defaults on it, defaults on repayment, the bank is in a very exposed position. They don't have security against the assets of the business. Overdraft facilities may be permanently in place. It may be companies have overdraft facilities on a continuous basis with banks. It doesn't mean, as I said, they're going to use them. They're just there for security, just in case. The business and the bank may agree to have the facility permanently available if required. But it doesn't mean that the company is going to make use of the overdraft facility. The interest charged on overdrafts is charged on the extent of the overdraft taken up. So if the company has an overdraft facility with the bank, it doesn't have to use all of the overdraft facility. It may just use some proportion of it. And the interest is charged on what it uses. So if it has an overdraft facility of £100,000 and it draws £10,000, then it'll pay interest on the £10,000 that it used, not on the £100,000, because it didn't use the rest of it. It just used, let's say, £10,000, and it'll pay interest on that. Interest on overdrafts is higher than on loan finance. In fact, interest on overdrafts can be significantly higher. So that's one of the reasons why banks are keen that businesses should have overdraft facilities. Maybe it's just tempting them into using it. Of course, they will only give this to companies that they believe are reliable and who will repay and are in the position to repay any overdraft taken up. But the companies are reticent to use overdraft facilities because it is very expensive. The rates of interest on overdrafts are quite considerably more than they would have to pay on, say, a traditional loan. When deciding on the sources of finance, the following factors should be taken into account. The control of the business will depend on the type of finance. If the company issues ordinary shares, then it's going to lose control in the business. There will be more people having a say in the running of the business. The business will in effect be controlled by 51% of the shareholders. Now, this is for, generally speaking, small types of business privately held with ordinary shareholders. But for large publicly limited companies, PLCs, the shareholders may be so many of them that they are disorganized, and therefore they don't run the business day to day, and they don't have much say in the dividends or in the control or direction of the business. It's left to a professional managerial section of the business. It'll be run by the CEO and by appointed experts who run the business. So we talk about the control of the business and the number of ordinary shares issued, and that a controlling group will be 51% or more of the ordinary shareholders. But with very large businesses, the shareholders may in fact be disorganized. Individual shareholders may hold a very small number of shares in the business, and it's not worth their while attending AGMs, the annual general meeting. It's not worthwhile them being involved day to day, because it's for each of them quite a small investment. Many companies may have investments, however, from fund managers, perhaps pension funds. Pension fund managers are there to look after the savings of individuals and make them available for the individuals when they retire from work. Make them available as, let's say, a monthly payment or repayment of past savings. So the fund manager, the pension fund manager, will want to invest these sums of money as people save over their working lives, and invest these in prudent ways. And they might invest them in large reputable companies. So the fund manager may have a say in the direction of the business, because the fund manager is seen as a powerful investor, not of his or her own money, but of the various savers who subscribe to that particular fund. But generally speaking, with, say, a smaller type of public companies, the number of shareholders, as that grows, there will be greater dispersion of power, and the board of directors must take into account the wishes of the shareholders. With private companies, and these are ones where shares are not issued to the public, With private companies, the issuer of shares, the invitation to other investors to buy a part of the business, will also dilute the power of the people who are distributing the shares. The shareholders who are inviting others to invest will be giving up part of their power to the new investors. And 51% of the ordinary shares will control the business. The business needs to calculate the loan servicing implications and make sure that it can meet its obligations. When the business borrows from the bank, it must make sure it can meet the obligations that the bank imposes in terms of the loan conditions. So it's not just the case that the bank issues a loan, or that the business goes to the bank and arranges a loan. The business must ensure that it can realistically repay the loan according to the terms of the loan. Raising additional sources of finance will have implications for the resources left available for dividend distribution. If the business raises a lot of loan finance, in other words, if the business is highly geared, it'll have to honour interest payments and repayments of the loans according to the schedule that was agreed at the time the loan was negotiated. But this will take out of the net resources of the business, and therefore less is available for dividends to the owners of the business, to the shareholders. So the business must think carefully about borrowing and how it can repay its loans, whilst at the same time keeping the shareholders happy, keeping them content with their dividends, and content that the business is still moving in the right direction and is on a sound footing. The various sources of finance should be matched to the need. For example, the purchase of land or other long-term assets should be financed out of long-term sources of finance. Long-term assets could be bought through long-term finance. So, purchase of land, for example. The land is going to be around for a long time and may appreciate in value. So that could be purchased over a long period of time, long-term finance. Overdrafts and trade credit should be financed from short-term requirements. The business does not want to pay high rates of interest on overdrafts, for example, or may want to control trade credit and may want to ensure that these are financed out of short-term, have short-term requirements and financed in short-term periods. Failure to match the sources of finance to the requirements is inefficient and dangerous. So perhaps the purchase of land, significant say investment on the part of the business, that could be very expensive, and attempting to pay it in a short time period may risk the business, may risk the business having a cash flow problem and having to raise alternative sources of finance which could be very expensive, even overdrafts, for example. So these are some of the issues involved in the sources of finance. It's important that you go back over the slides and understand the various points made on the slides, because sources of finance is an important issue in the start of a business and indeed in the management of the business. All businesses must have some appreciation of the issues associated with raising finance and the different types of finance that are available to them. So it's important that we have a good understanding of this. So it's important that you make good notes and have clarity about the different types of finance and their advantages and disadvantages. But that's all we're going to deal with here. I'm going to leave it at that and say thank you for watching.